Hi, I'm Jimmy. In this video, we're looking at how I personally use the PE ratio. Now, just so we're all on the same page, the PE ratio is one of the most popular valuation methods. And basically, it takes the stock price and divides that stock price by earnings per share. It's really a simple one. It works with most profitable companies, and it's one of the most popular valuation methods out there. But we're going to look at how I personally use it, and we're going to go through some real life examples as to how you could use it. Now, before we jump into that, I just want to tell you real quick about a website that we're building that it's called investorsgrow.com. And basically, it's designed to make valuing companies and analyzing companies quicker and easier. And we also have a private investing community that we do 3 live streams per week where we talk about economics, we talk about building portfolios, we talk about doing research on stocks, valuing companies, things like that. We have a lot of fun over there. If you're curious, link in the description below. But for now, let's jump in and look at the history of the PE ratio using the S&P 500. So this is the S&P 500, a chart of their PE ratio, the average of the 500 stocks going back to 1990. So we got about 35 or so years here, and we can see that the average over this time is about 19.8x. So let's, for rounding purposes, call it about 20x. But the issue here is that not all stocks are going to trade like the S&P 500 here. Clearly, we can look at this chart and say, well, 20x makes sense. That's the average. If you bought it below the average and then sold it when it got way above the average, you'd probably do fairly well, assuming you're a trader. If you're just buying and holding, like I am, well, then buying it when it's below the average probably makes some sense. But what if the charts don't look like that? In fact, what if a chart, a PE chart, this is a real chart, it's not going to tell you what company it is. Let me know if you guessed the company before we get there. What about this chart? This is a chart going back the past 10 years, so going back to 2014, of a PE of a real stock that I personally own. There's another clue as to what company it might be for the PE ratio. But here, buying it below 20x would mean that we would only buy this back in 2015 or so. Well, what about this stock? Clearly, the trend for this stock is moving higher. And when we want to look at the averages, well, the averages, there's not one of the averages that are at 20x like the S&P 500 is. In fact, this chart compared to the S&P 500 chart we saw was significantly lower. The S&P 500 chart, their average falls down here, again, at about 20x. So clearly, if we wanted to buy this stock using the S&P 500 as our sort of benchmark, well, we'd have very few opportunities to buy this. Now, again, focusing on the trend is higher, the first question might be, well, why is the trend higher? Is there a legitimate reason? And there's a couple things that we can look at. This is one thing when I'm analyzing a stock that I try to make sure to look at. And again, these are some charts from investorsgrow.com, but this is their net profit margins. So net profit margin is basically for every $100 that a company earns in revenue, what percentage of that $100 do they keep? So again, we can see that this one is trending higher. And recently, they're in the low to mid 30% range. So that means for every $100 that this company earns, well, they're keeping about $30 to $35 of the 100 as profit. In theory, they can use that money to pay dividends, buy back shares. They could do a whole bunch, invest in other companies, buy other companies. They can do a whole lot. Oh, by the way, company is Microsoft, for anybody who didn't catch that. I forgot to mention that. Company is Microsoft. And I think the important thing to note here is the most recent 5-year period is relative, it's higher, significantly higher than the first 5 years. So the numbers have in fact improved, as this might be another way to look at this is to look at it as the moat of a company. Buffett talks about, does a company have a moat? Companies like Microsoft, Apple, those types of companies tend to have moats. A lot of times in the numbers, you can see that in their profit margins. It is difficult to get profit margins this high unless you have a fairly loyal customer base and a product that is fairly sticky. So we can see that because the numbers have trended up, well, that kind of explains why the PE ratio has in fact trended higher. Now, back when I bought this stock, the discounted free cash flow calculation came out to be something like this. The fair value was at a bit above 240, and the stock was at about 230 and change. Well, that's where I bought it. I jumped in and bought it shortly after it dropped below the 240 per share, which is why I was interested in doing it. But when I go and double check the price to earnings multiple chart, well, instead of paying attention to let's say the overall trend or the averages are a great indicator. But when the whole trend is going higher, what if in fact we were to look at it like that? Well, when I bought this stock, the PE multiple was down a decent amount off of its recent highs. It was also below its shorter term averages, which was one of the things that made me feel good about it. Discounted cash flow showed it was undervalued. The stock was below its 5 and 10-year averages, which again made me feel better. But it was also on the lower end of the trend. And when I had done the research, I understood why a company that is showing faster growth rates, showing higher price profit margins, I understood why that type of company would be trading at a higher multiple. It makes sense for companies that are growing faster and have better profit margins to be trading at on average, a higher price to earnings multiple than a company like Walmart, which shows single-digit growth numbers and single-digit profit margins. Don't forget, the 20x of the S&P 500 is the average of all companies. Clearly, some companies are trading higher and some are trading lower. Some deserve to be a bit higher, some deserve to be a bit lower. Now, I want to be careful and point out that I am not suggesting that if the trend was moving higher, I think longer term trends, I would go a minimum of 10 years. This is a 10-year chart. If the number is trending higher, I wouldn't pay like 70 or 80x. I am looking for something that relative to their own history is a decent deal, but also we need to be able to justify the increase based on actual numbers in their financial statements. Now, just to give one more example of how we can try to use the price to earnings multiple is what about a stock like AT&T? Well, here's AT&T's stock, their PE multiple, again, going back the past 10 years. And we can see here that all of their averages are about 10x. So again, the S&P 500 is sitting at 20x, but it doesn't make any sense at all to pay anywhere near 20x for AT&T. I would much prefer to pay closer to, let's say, 5x when we look at this chart. Now, one of the reasons I wanted to make this video is I've had different conversations with people where they might say something like, they're telling me about a stock that they're interested in. They're saying, hey, listen, it's on sale. Right now, it's trading at about 15x. And then I find out the company's AT&T, but they're comparing the 15x to the 20x of the S&P 500. But if we look at the history, I think analyzing the history of that individual stock and perhaps some competitors of theirs is crucially important, because if we look at the history, well, we would see here that 15x is absolutely on the high end. If you're paying 15x for AT&T, we're paying too much money. I would much rather, in this case, pay about 5x. Now, 5x sounds like a ridiculous steal when you're comparing it to the S&P 500, but compared to their averages of 10x, I think it's important to note that compared to their average of 10x, it's on sale, but it's not compared to the 20x. So I just bring that out because I'm hoping to shake people, or at least to influence people to look at the history of that company and ideally some competitors as well, because some companies, it does make sense to pay more than the 20x. If the research and the underlying financials justify that, perhaps the growth rate, the profit margins, things along those lines. But also other times it makes sense to be nowhere near the 20x of the S&P 500. It's not on sale at 18x, 15x. This company is not on sale. But when you look at the history, you can see what the sale price actually looks like. Now, if you'd like to get access to this website and to our private investing community to see some of our live streams each week, I will leave a link to that in the description below. And if you're curious how to research a stock, I actually did a YouTube video called 8 Steps to Analyze a Stock. I'll leave a link right there and a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.